Ending once again, this is Seewing Yee from the Yee Real Estate Network, and my co-host is no other than Mr. Richard Advani from Supreme Lending, a one of the country's leading uh, mortgage loan consultant who has been helping investors from all over the world and all over the country to buy investment homes using great investment loans and financing strategies. And furthermore, he also consult with investors, not only doing loans to help them to strategize how the loans affect someone's scaling their real estate portfolio over time. And of course, he himself is a very hardcore real estate investor who have multiple properties spread across all over the US, great cash flow properties, great appreciation, and he continued to scale his real estate portfolio. So not only he's a real estate loan consultant, he's a real estate investor. He understands the trials and tribulations of real estate investors, mom and pop real estate investors out there. So thank you, Richard. You're an awesome person and great motivator and very good inspiration. You'll help a lot of clients and get a lot of referrals from existing loan clients over the years. So with that in mind, all right. With that in mind, today's topic is very interesting, and here are let me go over the summary of what we can discuss. We're going to talk about 5 points. The first bullet point we can discuss with, we're going to go over a real estate investor who's going to do 20 to 25% down financing to buy a cash flow property at 7% interest rate, which is the going rate today. 7% 30-year fixed rate mortgage for a real estate investor at 7%. Go with the scenario. What's the pros and cons of doing that? Or another loan option that someone have is, what if investor decide to buy down the points, and what are the effects of the cash flow with that? And the third bullet point is, what about doing another loan, like a 10-year interest only mortgage for investors, so they can get a lower payment on their loan without paying the principal at least the first 10 years. And then the fourth bullet point is another great option real estate investors can choose, is to buy with all cash. When you buy with all cash, you bypass this high 7% mortgage. You just bypass the mortgage and just have a much higher cash flow without a mortgage for those people that can afford it. And the fifth scenario, the fifth bullet and final bullet point is buy with investors buy with self-directed IRA. So before you begin, Richard, real estate investors' mindset is very, very different. In fact, real estate investors' mindset and criteria, I would say, is 100% different than a primary homeowner that want to buy than an owner-occupied buyer. An owner-occupied buyer and a primary home buyer, they're buying based on their mortgage payment, the monthly mortgage payment with their salary. If the income cannot support a 6% interest rate loan with the a company mortgage payment, they cannot afford to buy. They have to sit on the sideline. A real estate investor is much, much, much different. A real estate investors, all they need is 20 to 25% down payment. That is their at-risk down payment. And the rest of this, the criteria, they're going to have their tenant they're going to outsource a tenant to pay all of the investors' monthly mortgage, monthly taxes, monthly property insurance, property management fee, 5 to 10% vacancy, and 5 to 10% maintenance and upkeep. And at the end of the month, the investor with that rental property still have a slight monthly positive cash flow, or even higher monthly cash flow, depending on the situation. So with that said, I know I covered a lot of things. Hopefully you remember the 5 bullet points. Investors, given under this current real estate environment, have so many different options, multiple options, which the winner circle in this chaotic real estate market right now are potential real estate investors with all the things I've just discussed. So with that said, the floor is yours, Richard. I'm sure you have some great perspective. Go ahead and run down each bullet point from 1 to 5. Share with me your thoughts.
Well, I didn't write them down, so I'll do my best.
Okay, the first one is regular. Just go with the regular.
Actually, you know what? I have them in front of me. You did send them to me earlier. So yeah. I mean, the right answer is going to be different for each person, of course. I think, you know, one of the beauties of real estate is leverage, of course, and, you know, the fixed rate as a hedge against inflation. And a lot of people out there don't necessarily to pay cash, but we're at a pretty rare spot right now because the interest rates are high, where your cap rates are actually higher than your cash on cash returns, right? So if you were to buy a lot of these properties that you're barely making any cash flow on with financing, you'll actually make a 5 to 6% cap rate on it, you know, with the cash acquisition, which is interesting because normally you needed the financing to generate obviously the needed return. So, you know, there is a way around the high interest rates if you have the liquidity and still have the ability to make a sound investment, right? By paying cash for these properties. Now, you know, you have the option obviously is to go with the 7% loan, you know, buy down the points with that is something I'd always recommend because it gives you obviously a better return on your investment. And most of the time the break-even points are, you know, within a relatively short period of time. There are alternative loan products available out there as well, like, you know, the interest-only loans that we offer. Some people are offering ARMs. And look, at the end of the day, I really like the fixed rate interest-only loans just for that reason. They have a fixed rate for 40 years. They're interest-only for 10 years. They allow you to take advantage of that increased cash flow with the interest-only until rates go down and or, you know, until rents go up. But also, once again, it's a fixed rate, you know, and I'm really a big proponent of that. I think adjustable rates could be a little tricky from what I've seen in the market. They're not dramatically lower than the fixed rates, although you do assume a good amount of risk, you know, because 4 or 5 years from now, 6 years from now, you're going to have to potentially refinance that depending on where the rate market is. And then, you know, of course, buying with a self-directed IRA, you know, that is and always has been an amazing option for investors, especially if you don't have a lot of liquidity. I mean, either way, you know, but let's say you don't have the ability to save up down payments, but you do have a retirement account. Most of the time it's invested in the stock market, which we all know where it is. A self-directed IRA allows you to purchase rental real estate in your IRA. That way it grows tax-free, which is huge, right? The income, appreciation, all of it grows tax-free. And also there are companies out there now that will provide leverage to the IRAs as well. So, you know, you can put a down payment through the IRA, you can get a loan through the IRA. That way, you know, instead of plopping 250 grand on buying one home, you can use it to buy, you know, 3-4 homes utilizing leverage. And, you know, like I said, regardless of whether you have rentals outside of an IRA or not, having them within an IRA gives you all of those tax benefits. You know, so it's another great way to purchase a rental property. But, you know, at the end of the day, I think looking at the cash purchase is a real gauge of where the property is as an investment, regardless of the rate market. 5% cap rates are pretty good, you know, for a cash acquisition. And, you know, I'm not saying don't leverage, still leverage then. Know that overall it's a good acquisition. However, initially your cash on cash is going to be lower until you refinance or until rents go up. But it does take us back to the question is if you got hundreds of thousands of dollars sitting in the bank in a low interest bearing account, you're losing money. You might as well pay cash for one of these rentals, have cash flow right away, and obviously start making the wealth building aspect of the return. You know, the appreciation, the hedge against inflation, and, you know, depreciation. A lot of that income is going to be tax free to you as well.
Yeah, well, people that are buying all cash, I understand, but they have an additional option. They can cash out, refinance that house later to leverage into several more properties down the road if they want to do that. So just to give you some thoughts. So now one caveat that you and I need to clarify: you just can't go anywhere in the U.S. and use these loan options or all cash or IRAs to buy investment property. You have to buy in the right market, a market that where the numbers make sense. And you and I know we service the same clientele, almost the same type of mom and pop real estate investors. Most of them come from California, of course. But the key is you have to find the right market. You have to find an affordable market that can match the rent that you are collecting. And so, with that said, let's just eliminate the area of the U.S. which does not make sense to cash flow under any circumstances in my mind, which is the West. Anything west of Mississippi, as I see it, you should not buy investment property anywhere the west of the Mississippi, not Kansas, not Minnesota, not Washington State, for certainly not California, not Idaho, not Las Vegas, not Arizona, not Colorado, not Utah, because the median price of those homes in those areas, like 400K or higher, you cannot expect to collect $3,500 rent or $4,000 rent at 1% ratio in any of those markets in the western side of the U.S., west of the Mississippi. So therefore, the only area which I recommend a turnkey mom and pop investors, and you service a lot of those clients as well over the years, is to buy in the Midwest for very, very cheap, inexpensive markets, be it very blue collar, a rust belt market, it's a cash flow market, fine. But the best hybrid market where you can potentially get cash flow and appreciation is the South and Southeast, Texas, Florida, Georgia, Alabama, Tennessee, North and South Carolina, and that's pretty much it, because those markets, if the median price of homes around 300,000, even as we speak, if you can buy an investment home for 300K or lower in those markets in the South and Southeast, and it rents for 0.007% rent to value ratio, if a 300 grand rents for 2,300 a house, if a $250,000 rents for 1,900, if a $200,000 rents for 1,700, if 100 grand property rents for 1,000 monthly, those are the right numbers to trigger. Those are the metric. Those are the benchmark to use. So yeah, don't use all cash purchase to buy a $1 million home in California and you only collect $3,500 rent. The yield and the cap rate will be negative. So anyway, that's my big picture in relates to the loan option that we discussed. So just to recap, Richard, the recap is today, real estate investors that have 3 loan options. One is to just outright get the conventional investment loan at 7%. Just go with flow, get break even or positive cash flow with 25% down payment. And the option is buy down the rate for better cash flow, buy down the loan rates, pay the points. And the third option is use the interest only 4-year mortgage, 10-year interest only for lower payment, getting better cash flow. And the last loan product you may not like that much is the ARM loan product. And then the other way, the second way is buy all cash, which is pure cash. And the third way is using your self-directed IRA to buy either a full cash purchase with the IRA, use a 50% down payment with the IRA, and use a non-recourse loan to leverage the other 50% of your IRA purchase on a property. So that's my big picture recap. So before we leave, so what are your takeaway? What is your recap before we sign out?
Absolutely. Yeah. I mean, no matter what tool you leverage to purchase real estate, it still is obviously proven to be a good long-term investment. If you have the means to do cash acquisitions, that's high cap rates, although, leverage is what makes real estate beautiful. Right. And as discussed, whichever option you take, there are options to take advantage of financing when rates are low, whether that means adding financing to something you bought in cash or refinancing something that you used a loan to get. But the last thing I'll say is, look at the delta between what the rates are and what the inflation rate is, and you will still see, if you understand inflation, that a 6.5 to 7% investor rate is still cheap money based on where the market is.
Yep, I totally understand. So my one final takeaway is, even under this current crisis housing market, with all the doom and gloom negative headlines out there, the risk investor, if they, if they analyze things correctly, if they listen to our message, they will be more inspired to take action right now, instead of waiting on the sideline, whatever. So thank you so much. That's all I have to say. And once again, thank you for your time, Richard Advani from Supreme Lending. This is Seewing Yee. Have a nice day. Take action. Overcome fear. Have a nice day. Bye-bye.